Tesla reported Q1 earnings a few days ago, and right away, the stock rallied 12% the following day. So, just by looking at the stock's price action, you might think that Tesla just reported blowout earnings. Well, it's quite the opposite. Results were, in fact, a disaster. So, today I want to go over Tesla's Q1 results and why the stock is up so much over the last few days. Keep in mind that Tesla is still down 60% from its all time highs, so I will talk about valuation as well and what I think about the stock moving forward. With that being said, I have the article version of this analysis in the description box below for you to read. And without further ado, let's jump into Tesla's Q1 results. For the quarter, revenue was $21.3 billion, down 9% year over year, which also fell short of analyst estimates by nearly $1 billion. And this was primarily due to lower automotive revenue. As you can see, after years and quarters of high double digit growth, Tesla's business experienced its first ever year over year decline since Q2 of 2020, when the pandemic lockdowns had a negative impact on sales. But today, there's no lockdowns or supply chain problems whatsoever, so the decline in the business is even more concerning. Breaking it down by segment, Q1 automotive revenue was $17.4 billion, down 13% year over year, mainly due to one, lower average selling prices as a result of price cuts and vehicle mix, two, lower vehicle deliveries, which declined 9% year over year to 387,000 vehicles delivered in Q1. There were production and shipping disruptions in Fremont and Berlin, which affected deliveries. And finally, lower global EV demand as many car makers prioritize hybrids over EVs. So the bad news is that automotive sales are down, but the good news is that this might actually be the bottom in terms of growth rate for the segment. As mentioned by management during the earnings call, Q1 had a lot of different things which are happening, including seasonality, attacks at their factory, and Model 3 and Cybertruck production ramp, which they don't expect these things to reoccur in subsequent quarters. And even Elon confirmed that Q2 will be a lot better. So, this is one reason why the market is ignoring the ugly revenue print this quarter. Moving on, services and other revenue made an all time high in Q1 after being flat for 3 consecutive quarters, as you can see right here. Services and other revenue was $2.3 billion in Q1, up 25% year over year, and this was mainly driven by higher paid supercharging, higher part sales, and higher used vehicles revenue. It's also worth mentioning that Tesla began opening its North American supercharger network to additional non-Tesla EV owners, which should accelerate EV adoption and usage of Tesla's superchargers. Keep in mind that as of Q1, Tesla has more than 6,200 supercharger stations and 57,000 supercharger connectors, which are up 26% year over year and 27% year over year, respectively. So the supercharger network is growing, and as more car makers join the network and as more consumers use Tesla's supercharger, we should expect robust revenue growth for the segment moving forward. And last but not least, we have Tesla Energy, which generated $1.6 billion of revenue in Q1, up only 7% year over year. So growth was mainly driven by higher energy storage deployments, which increased 4% year over year to a record 4.1 gigawatt hours, offset by lower solar deployments, which management decided not to report in Q1. So I guess things are looking really bad for the solar business as experienced across the solar industry currently. That being said, despite the slowdown in the segment, management expects energy storage deployments for 2024 to grow at least 75% higher from 2023, which means we could expect growth to reaccelerate throughout the remainder of 2024, which is great to hear. And growth for this segment is really important because Tesla Energy is the most profitable segment currently, which I will talk more about later in the video. But just to recap what we've discussed so far, all three segments are slowing down meaningfully, especially for the automotive segment, which is down year over year, even despite lower average selling prices, which tells us how bad the demand landscape is for high ticket items such as EVs. We can blame this on high interest rates, which have remained higher longer than expected, And people were expecting interest rates to come down by now, but as it turns out, we may not even see a rate cut this year. Or worse, we might see rates go up even more, which could really put a strain on Tesla's business. That being said, I think we're at the peak of the interest rate cycle and we should see interest rate cuts soon. And when that happens, demand for EVs and solar should pick up once again, and that should reaccelerate Tesla's growth. Whatever it is, Tesla still has a long growth runway ahead in EVs, solar, and other projects. It's just facing temporary macroeconomic headwinds. Turning to profitability, Q1 gross profit was $3.7 billion, down 18% year over year, representing a gross margin of 17.4%, which is down 190 basis points year over year and 20 basis points quarter over quarter. And as you know, the decline in gross margin was primarily due to lower average selling prices. So if we look at gross margin by segment, we can see that automotive gross margin, which is the dark blue line right here, has been on a downtrend, again due to lower average selling prices. In Q1, automotive gross margin was 18%, down 300 basis points year over year. Management did mention that if not for Cybertruck production ramp and unscheduled downtime, cost of goods sold per unit actually declined quarter over quarter, driven primarily by lower raw material costs. That being said, despite improvements in cost of goods sold per unit, it wasn't able to offset the price cuts, which is why automotive gross margins are declining. On the other hand, energy gross margin continued to improve, which was 25% in Q1, up 1,400 basis points year over year. As I mentioned earlier, management expects energy storage deployments for 2024 to grow at least 75% higher from 2023, and they also expect consistent profit growth from this segment. So that's good news because strong revenue and profit growth from the energy segment should provide some cushion for lower automotive gross margins. Nevertheless, lower automotive gross margins is still a big concern because the automotive segment makes up more than 80% of Tesla's total revenue. I think automotive margins need to bottom before the stock goes higher. As for the services and other segment, gross margin was 4% in Q1, which declined 300 basis points year over year, and this was due to lower used vehicle profit. That said, I expect gross margin from this segment to improve over time as Tesla's supercharging program gains momentum. Moving down the income statement, operating profit was $1.2 billion, down 56% year over year, representing an operating margin of 5.5%, which declined 590 basis points year over year. And this was due to lower gross profits as well as higher R&D expenses driven by AI, cell advancements, and other R&D projects. While operating margins are on a decline, Tesla recently laid off more than 10% of its workforce, which should generate savings in excess of $1 billion annually. As such, we can expect operating margins to improve from here. Looking at the bottom line, Q1 net income was $1.1 billion at a 5.3% margin, which was down 500 basis points year over year. On a per share basis, GAAP EPS was $0.34, down 53% year over year, and non-GAAP EPS was 45 cents, down 47% year over year, which missed analyst estimates by 5 cents. So really, there's no way around this. Tesla's profitability is turning worse and worse, despite management saying that they have improved cost per vehicle, and it all comes down to lower average selling prices. Bulls might say that Tesla is sacrificing margins today to grow as much market share as possible so that one day they can collect high margin revenue through FSD or robotaxis or whatnot. On the other hand, bears might say that Tesla is forced to cut prices due to competition or weak demand or both. Whatever the reasons, we can't deny the fact that Tesla's earnings power is getting weaker and weaker, and I think Tesla needs to return to growth mode and improve margins, more importantly, automotive gross margins, to really instill confidence among the markets. Looking at Tesla's balance sheet, Tesla currently has $26.9 billion of cash and short term investments, with total debt of about $5.4 billion. placing its net cash position at a healthy level of $21.5 billion. Now, the good thing about Tesla is that the company has a positive net cash position with very little debt relative to its peers. This has always been the case, and I think this is one of Tesla's main competitive advantages, that it has a very strong balance sheet. However, I do want to point out that its cash position dropped $2.2 billion quarter over quarter, as you can see right here. And that is due to a negative free cash flow of $2.5 billion in Q1, which is the first time free cash flow turned negative in over 3 years. So free cash flow turned negative because of two reasons. The first one being higher inventory levels, which increased $2.7 billion quarter over quarter. And this is probably due to the early phase of the production ramp of the updated Model 3, as well as shipping diversions caused by the Red Sea conflict and from an arson attack. The second reason is higher capital expenditures, which was $2.8 billion in Q1, which included $1 billion of AI infrastructure spending. So this is actually a good thing, as it means that Tesla is investing for future growth. That being said, while the negative free cash flow in Q1 was an unpleasant surprise, management did mention that they expect the inventory build to reverse in Q2 and free cash flow to return to positive as well. So that's great to hear. All in all, nothing to worry about in terms of Tesla's balance sheet. The company has a high net cash position, so one bad quarter doesn't really hurt the company. I think this is just an unusual quarter, and I think the company should return to free cash flow positive in Q2 and beyond. Turning to the outlook, management expects vehicle volume growth rate in 2024 to be notably lower than the growth rate achieved in 2023. This is in line with their previous guidance, so nothing new here. As a reminder, Tesla had negative growth in Q1. However, during the earnings call, Elon mentioned that Tesla will have higher sales this year than last year, which means that we can expect growth to re-accelerate during the remainder of 2024. Regardless, growth will be quote-unquote notably lower, with analysts expecting only a 2% growth in 2024, which is pretty bad. Next, they also expect growth rates of energy storage deployments and revenue to outpace the automotive business, which is quite obvious in my opinion, so no surprises there. But here's where things get a little interesting. As you can see, management has updated their future vehicle lineup to accelerate the launch of new models with an S, meaning it's not just one model, ahead of their previously communicated start of production in the second half of 2025, meaning we'll get to see Tesla's new vehicles as early as late 2024 or early 2025. In addition, these new vehicles, including more affordable models, will be able to be produced on the same manufacturing lines as their existing vehicle lineup, meaning consumers don't have to wait for another factory to be built out, and they don't have to wait for years before they can get their hands on these newer models. So more models coming earlier than anticipated made a lot of investors happy. Not only that, but Tesla also plans to unveil its robotaxi product, or Cybercab they call it, in August this year. They even show a prototype of what the robotaxi service will look like in the Tesla app. So that's very good news for investors. I think they can already imagine the robotaxi service coming live. And this could be made possible through the recent progress of Tesla FSD, which has accumulated over 1.2 billion miles worth of data. And to accelerate further adoption, Tesla has also lowered the price of FSD to $99 per month or $8,000, which should consequently speed up FSD data collection and development, allowing Tesla to scale fully autonomous vehicles for its robotaxi service sooner than later. Even with all these announcements, management is not done yet. They also talked about Optimus, which is Tesla's humanoid robots, possibly going to market by the end of 2025, which is absolutely insane if you think about it. To go from doing simple factory tasks to selling it externally in less than 2 years is just ridiculous, I think. But a lot of investors are buying into that idea, especially considering that Optimus could be more valuable than everything else combined. So my thoughts is that management did a really good job in selling their vision. They even added this chart showing the Tesla ecosystem and how they are more than just a car company. I totally agree. Tesla is more than just a car company, but keep in mind that some of these products may take years before they get commercialized. And so I think investors shouldn't get their hopes up too much. But it seems that investors don't really care about the timeline. They only care about the story of the company and where it is heading, which is that Tesla is going to unveil new models soon, robotaxi services are going live soon, Optimus is going to market soon. And that is why shares rallied following Q1 earnings, despite weakening fundamentals. I won't spend too much time on valuation because valuation is very subjective, especially when it comes to Tesla stock. But as it stands, Tesla stock trades at a price to sales multiple of 6.2 times and a forward PE multiple of 65 times, which is quite expensive considering that analysts expect only a 2% revenue growth in 2024 and a 17% decline in earnings per share in 2024. So based on multiples alone, I think Tesla looks fairly valued to slightly expensive. I understand that Tesla trades at a premium given the hype factor and growth story. I mean, the premium would be justified if fundamentals are improving, but as you saw earlier, fundamentals are going in the wrong direction. So because of that, I would prefer a wider margin of safety. That being said, I have a price target of $175 a share for my base case, which is about a 4% upside from today's price of $168. That's based on the assumption that revenue grows to $371 billion by 2033, which is about a 14% CAGR with a free cash flow margin of 17.3% and based on a perpetual growth rate of 3% and a discount rate of 10%, I arrive at an intrinsic value per share of $175. And I've also included my bear and bull cases here, but all in all, I'm neutral to slightly bullish on Tesla stock currently. In addition, the stock seemed to have bounced perfectly on its long-term trend line, which could signify a bottom. Other than that, I want to bring up a piece of news that former Tesla executive Andrew Baglino, I'm not sure if I mentioned that correctly, but he has sold out his entire Tesla position worth around $181 million days after he resigned from the company. Now, Andrew has been with Tesla for almost 2 decades, so to see a top level executive resigning and selling out his entire position is quite concerning. There could be internal problems or management conflicts. I don't know, but I thought it'd be good if you guys know about this because it is a big deal after all. So, what can we learn about Tesla's Q1 results? Well, we can learn that investors don't really care about the fundamentals of the company and instead they care about where the company is heading. We can see that virtually every single metric from revenue growth to earnings per share looks terrible, but investors are sold on the idea that profit margins and revenue growth are set to expand in the future due to products such as FSD, robotaxis, and Optimus, and that is why shares rallied following Q1 earnings. While I agree that Tesla is at the forefront of a few megatrends including AI, robotics, and autonomous driving, it's hard to ignore the fundamental damage that Tesla is going through currently, which is why I prefer a larger margin of safety if I were to invest in Tesla stock. The vision, the story is definitely convincing, but I need it to be backed up by strong fundamentals. If not, I think it could be particularly dangerous from an investing standpoint. But that's just my thoughts and not financial advice. But now I want to hear from you. What do you think about Tesla's Q1 results? Are you a buyer of Tesla stock? Please let me know in the comment section down below. If you enjoyed this video, please don't forget to subscribe for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys on the next one.